Good day to one and all. This is Dr. Sivaram of IKnowIndustries.com. I'll be presenting in coming 30 minutes the spike trade calls pre-non-farm payroll data release. Today we are on 10th of March, Friday, between 11:30 and 12 GMT. I like to give you the trade calls. And before that, I have to explain to you on what basis these trade calls are given. So in my trading system, I take into consideration three basic components, namely the forecast, which is derived using a scientific algorithm. Then I do the market reading in order to fine tune the forecast, then use the trading strategy to limit the risk and maximize the profit. So we need to understand that whenever we have uncertainty with regard to the market, when we normally have uncertainty, because when the market is expected to react for that of the fundamental data release. So today you come across that non-farm payroll data has to be released in US 13:30 GMT. So all are expecting either a underperformance or above than that of the expectations. So there could be two possibilities in the market. So when the possibilities are more than one, then uncertainty grips in whether the market will go up or come down. Also, people might have the confusion whether it will be favoring US dollar or it will be against US dollar. So in such a situation, they go in for various type of analysis with regard to the past performance. So in past or in the previous months, during that of the non-farm payroll, how exactly the market has made the moves. And after that of the release, how much of gain or loss the market has made in the case of euro and GBP or yen or whatever it is. Then they subsequently study with regard to the past performance with the disclaimer, the past performance does not guarantee the future. So again, it is not a solution for the uncertainty. So how do we get rid of this uncertainty? For that, we need to find out the exact intention of the big players in the market. The big players are the one, they are going to push the market either on the upside or on the downside. So whichever way they have to move, they have done the preparations beforehand. They don't gain anything if they simply give a knee-jerk reaction of rise or drop in the levels of euro or GBP soon after the release of the data. When they make such moves, they don't make any profit. But what they have to do is, if they want to make a rise, they have to first of all accumulate huge buy positions. Then when they quickly gain the level using the sentiment created by that of the data, they will be able to book profit with regard to their buy positions. And in the event, if they want the market to drop, then whatever be the data, they can give a different type of interpretation using the media and say that even though the data is good, but people are going for risk aversion. And then simply they can drop euro and GBP, or if the data is bad, still they will say that it is a risk aversion. Because of that, euro and GBP has come down. Basically, the players have built huge sell positions. So they want the market to come down so that they can buy against their sell. And that means the traders have taken huge long positions so that when they drop the market using the data releases the trigger time and keep the market at a lower ebb, then automatically, because being Friday, people do not want to carry the positions to that of the next week, because over the weekend some uncertainties could happen and they won't have access to that other platform and their positions might make huge loss. So with that uncertainty and the fear, they going for a distress closing of the positions. So every time you come across a data is being released, the players try to see in such a way that they are able to make huge profit. So they do the groundwork beforehand, but we are not aware of it. So we need to read their intentions when they are making such moves in the market. If you watch from that of Monday this week, you know very well they have been keeping Euro and GBP at a lower level. They started GBP around 1.23 last week and then slowly came down to 1.2150 level. In the case of Euro, they have been holding around that 1.06 level. Slowly they came down to 1.05 level, started gaining it. And in the case of yen, it was holding around 113. They gained the level to 115. So here you find in all these currencies, they have been all along keeping the market at a lower ebb with a feel to be created to that of the traders that US dollar is the king. So when the traders have developed the US dollar bullish sentiment, they are afraid of taking buy positions. So what the traders try to do is, whenever there is a pullback in the levels of Euro and GBP, they try to take sell positions, and whenever there is a small drop, they book profit. And especially the scalpers, they think that market is subdued, making sideways move. Maximum spread in the market in the whole week is only about 100 pips. So if they could take sell positions whenever there is a pullback, and automatically you'll find that when they drop, they will be able to book profit. So such scalpers, in order to increase the profitability of their scalping, they increase the volume of positions. And profit aim will be for about 10 to 15 pips. So instead of taking one lot and aiming for 15 pips or 10 pips, they will take about 20 lots or 30 lots and try to aim for about 5 to 10 pips so that the profit earned will be higher. So the scalpers, they try to imagine that way with regard to the profit, but they do not envisage the amount of risk when the market goes suddenly against them. This is what happens during that of the data release time. And many of the traders also think that why to trade in majors? They are going to be affected by the data release. But if you go in for the crosses, they are unaffected by that of the US dollar sentiment or US dollar or euro sentiment or whatever it is, and they will follow the technicals. So the pure technicals we can follow and try to take positions. But the players make moves in such a way. Now you can see that euro is in positive net change. USDN is also in positive net change. This is a typical contrarian move they make. If you see the net change, it is a typical contrarian move they make. Euro is making US dollar weakening move, and USDN is making US dollar gaining move. So by that, they are in a position to show it in the market, a mixed reaction. Then when euro yen goes up, then immediately the traders think that it is a sell level, it has come to that of the resistance. But when suddenly euro jumps up, when US dollar yen is not dropping for that of the non-farm payroll release, what happens? Then euro yen also jumps up in a very big way. Then later on, they drop USD yen. So they are very smart in order to trap the traders. So they don't make that US dollar weakening or the US dollar gaining moves all the time. They alternate with that of the mixed move or contrarian move in the market. Because of that, they are able to make stop-ins in the case of the crosses. So whether you trade in major or in cross, you need to get rid of the uncertainty in the market. Only then you will be able to commit positions. They want the traders to follow technicals and fundamentals and commit positions, but the players give a different type of interpretations later on using the media and other freely available analysis. Thereby, they are able to easily induce the traders to commit positions and then trap them to earn back their money. So, in the process, the players continue to earn money and the traders lose the money and say that this is not the place to earn money. And you come across that many of the traders become disgusted because they are asked to do something and they, in a very honest way, follow those things. But later on, the players dig the pit behind them and make them to fall. This is what you find in the market. So you have to be smart enough. You can't commit mistakes again and again. See, only a fool can commit mistakes again and again. A wise man is expected to correct himself from that of the past mistake. So try to be a wise man. That is possible only if you control your emotions and see that you read the market carefully. It is a man-made market, so when men manipulate the market and being opponent or being on the other side with a smaller equity, we will not be able to fight against them. But we can try to read their intentions and trade along with them to earn money from that other market. So first of all, the first component being the forecast. So it is a statistically derived forecast which I give it on Mondays for the entire week, and on 6th of March I have given on 10th what is expected to happen. Now today they just made the swing and rise during that of the Japanese session, and then swing and slide is expected. So they are expected to make a dip before that of the non-farm payroll release. Now it is 11:42 GMT. 13:30 GMT is the data release time. We just watch between 13 and 13:30 GMT. They will try to make a dip in the market and try to give that impression that again the data is going to be robust, and as a result Euro and GBP are expected to collapse. That is how they will try to bring in the sentiment. But soon after the release of the data, they will make some volatile move to start with to create the uncertainty and hit the stops of those who have taken scalping and then subsequently rise the market. This is what the forecast says. Then during that of the US session, from 14:30 to 21:30 GMT, they are expected to slowly swing and firm up for the weekend. So continue to gain the levels in the case of Euro and GBP during that of the US session, and that is how they are expected to make the move in the market. This is the forecast part of it. Now we have to do the market reading. So market reading, I note down the initial lows and the highs around 3:30 GMT during that of the Japanese session. And during that of the Asian session live market analysis review part today, I just showed how exactly these initial lows and the highs were noted down, and they are compared from time to time to the double live market code page. And you know that in the case of Euro, the low was 1.0572, the high was 1.0599. They set around 3:30 GMT. Now they just gained the level above that of that and went up to 1.0619 and holding above that of 1.0599, indicating that they are likely to gain more levels in the case of Euro as a intentional move on the upside, because they are holding above this initial high for more than 30 minutes up to 2 hours. Then in the case of GBP, the low was 1.2150. They just breached and came down to 1.2147. Just they made a brief downward stop and come above to 1.2153 level and 1.2165 5 was the initial high. They went up to that of 1.2180 and came down. So they just increased the spread between the high and the low. Initially it was very low. Then subsequently they made a brief upward stop and came down and made a brief downward stop and holding, so that whether you are taking a buy position or a sell position, they try to hit the stops which are closer to that of the day low or the high. So this is what they try to do it in the market. And when the traders lose, the players earn money. So that is the principle by which they operate the market. It is not that they will gain big when make US dollar strong or euro strong, etc. They are interested in making money, and they are least bothered whether it is US dollar which is giving them the profit or euro which is giving them the profit. So they want ultimately the profit. And so we also view the market with such perspective. Only then we will be able to really understand. So following the technical might appear that it should be fundamental. It should be the scientific way of watching. It is a scientific way of watching the uh, market. But actually, when the market is not manipulated, then such scientific things will work. When the market is manipulated by other human beings, they know very well where the weakness of the traders are, and then they try to shift the market sentiment and suddenly give a knee-jerk reactions to that of the traders when they are unexpectedly caught. So when they are caught unaware, automatically the traders have got no other choice than to either liquidate the long position when there is a sudden drop, or go in for a huge short covering when they are holding sell positions in other majors. So keep that in mind and try to see that the players do that stop-ins. And so we have to be very careful. Avoiding keeping the stop is not the solution for it. As I explained, that we have to use the hedge order to limit the risk, and when they make a move in our favor or against, we should be able to book profit on either positions. Now in the case of yen, 114.89 is the low, 115.25 was the high. They went up another 25 pips to 115.50 and holding there. They could make another extended upward stop and before making a big drop in the case of USD yen, because they are making contrarian move, and especially in order to handle yen crosses. When euro is gaining, suddenly they will gain level also in the case of USD yen. People will be surprised and get confused, and then they will make a big drop in the case of USD yen. So keep that in mind and trade accordingly. So it is not that going to be a clear US dollar weakening or the strengthening sentiment. They are expected to make mixed moves in a market. And there is question from YouTube, Addict on. So today euro is in buy or on news. Yeah, we can do the buy. Euro is expected to go up. We can do the buy, but not at the current level. So they are expected to make a false move before the of the data release. I'll come to that. I will give the recommended trades in the levels. At that time, you can around those recommended levels you can take a buy. Not after the rise we should pay, because the ideal way of doing the trade is whenever they create the bearish sentiment and dip euro, you buy. Then immediately you find that they gain the level and they just deceive all the traders, avoid them taking positions, and then see that they go in only for the short selling after the rise, and then continue to trap by gaining further level and induce them to do the short covering for the weekend. So if you got any question, kindly ask. I'll answer to those questions also. Then in the case of CHF, 1.0116 is the low. They just breached it by 2 pips to 1.0114 and then gone up. And the high is 1.0131. So they are likely to hold and then suddenly make a drop in the case of USD CHF. They made a brief downward stop and holding in the middle level. Then in the case of Canadian dollar, 1.3495 was the initial low. They just came down and went up 1.3486, and they are holding well below that of the initial low 1.3495, indicating that they have built huge sell positions in USD CAD in a narrow range when they are holding high. And because before that of the non-farm payroll, most of the traders who have gone short would have gone for a short covering, thinking that in the event if USD CAD goes up further, they'll be facing huge loss. But they just breached the initial low and come down and then holding below that, indicating that they will make a big drop in the case of USD CAD. Australian dollar, then the low was 0.7499 and that is not breached. The high was 0.7524. They went up to 0.7530 and came down to 7520 and not reach the low. Any small dip, they are expected to make a dip before making a rise. So we clearly see that they have been holding the market in a narrow range from that of 3:30 GMT up to 11:50 GMT, not making a big headway on the upside or on the downside. So indicating that the players are just waiting for the outcome of non-farm payroll and then try to make big moves. So they are simply holding the market in the middle level, and later on they are expected to make a slide about 15-20 pips or 30 pips dip before that of the data release, just to give that impression as if the data has already been out, and later on when the traders find the actual data, the players are expected to gain the level quickly. So watch and understand. I'll come back by 15:30 GMT and review the calls what I have given now as a trade call. So this you can try it in a demo trading account, and you know that people visualize there is a great risk during that of the data release. But if you could perceive with the right understanding, then it is a great trading opportunity. So it is a question of mental perception. So once you develop the confidence, trade confidence, it is something like balancing a cycle. So once you learned how to balance a cycle, then you can go very fast in the cycle. You can tilt the cycle any way you want and still it will not fall. And otherwise, if you do not know how to do the cycling and if you claim on it, and people will immediately say, be cautious, you might fall. You will have to balance it. If you do not know how to balance, you might fall and you will get hurt. So that's what they say. So there are two perceptions. One, during that of the data release time, if you do not know how to perceive the market, then you are under the great risk. Then people say that conserve your equity, avoid taking positions during that of the data release, and later on let them show the true intention and we can commit position. But what happens? Already if they have gained the level in the market, then you don't get really a great opportunity to enter into that of the market. You feel disappointed. You feel that you have missed that great opportunity. But instead, you try to recognize the opportunity and take the position, but don't take unlimited risk. You keep the hedge order to limit the risk, and you have the facility in the trading platform as the entry stop. So when you use the hedge order, then it will be acting as like a stop. And if it is not filled, and when the market moves in our favor, you can always keep stop at entry and then remove the hedge order. Even if it is hedged, then you see that whether the hedging is making profit or not for about 30 minutes. If it is not making profit, then you can understand that it is filled during that of the stop, and which the players do very frequently. And Then you simply close it with 1 or 2 pips loss and keep another hedge order so that you find that the market moves in your favor and you are holding a position. If you use a stop, what happens? The stop closes your original position. Even though the market moves in your favor, you don't have a position to make profit. So keep that in mind, and then you try to watch how exactly they are making the move. They started making that dip now, and so around that of the new low, now GBP, they are just making a dip to 1.2140, and once they stop cutting it for about 10 minutes, you try to take a buy. And in the case of euro, they could make a dip probably below that of 1.06 quickly during that of the non-farm payroll data release, and they could gain the levels in the case of JPB and drop in the case of euro just to confuse the traders. So that is what, because they are showing it as a positive net change in the case of euro and negative net change in the case of JPB, they will just reverse during the last 30 minutes before the data release and then confuse the traders. And in the case of Australian dollar, another 5-10 pips, if they make a dip, you try to take a buy and keep the hedge order to limit the risk. And in the case of USD yen, they are just still holding above that of the initial high 115.25, and they are making a duck, and it will give the impression that it is a sellable level. But what they will do, they will make 11th minute stop, and during that of the data release about 15-20 pips above the high what they are set, and then start making the drop. Okay, they will be smart enough to handle these stops, so we have to be doubly smart to earn money from that other market. Then Sherlan says that, so euro is a sell. No, I'm not recommending you to sell at these levels. You can do a scalping, but you wait for the great opportunity. See, you try to be an opportunity trader in the market. When they make a small dip, when I say that euro could come down to 1.0570, immediately don't think in a counterproductive way that I can take a sell around 1.06 and book profit around 1.0570. That is not going to happen, because they will show it for a fraction of a second the low, and you will feel out of greed, okay, let it come down further because the non-farm payroll is still stronger, so US dollar has to gain, euro might go down further. That's what you'll be thinking. By the time they will simply rise and hit your stops and go above. So don't try to think in that lane, because the players are very smart. Okay, and you cannot outbeat them just like that. Instead, you be patient. I always say that market rewards patience. You be patient, look for the right opportunity to enter, so that you'll be able to grab great profit out of that. But when you do a sell and buy trade, you might get about 10 to 15 pips. But if you do a buy and sell trade, you will get about 70-80 pips. You decide which one you prefer to. And while aiming 10 to 15 pips, we should not lose that opportunity of earning 70-80 pips. Many of the traders do that. They look for small opportunities and just miss the greater opportunities in the market. I always tell the people that be an opportunity trader, as we will not be able to trade against that of the players, and we can always trade in line with that of the players if you understand what they are trying to do it in the market, because they are committing positions and they have to exit out of the positions. They can't take delivery of those leveraged positions in the market like the stock market. So understand, they create the bearish feel and buy, and create the bullish feel and book profit in their positions. Is it necessary to do a trailing stop after the data release? Now, if you use the trailing stop, you have to be very careful, because the platform providers try to catch all the trailing stops and fill. So you have to manually trail the stop if you want to be a smart trader. Then Sherlon, what is your prediction on gold? Gold is also is expected to make a small dip and then gain after that of the non-farm payroll during the US session. It is expected to lead the market on the upside. Any other question? So I'll try to wind up the webinar. These are all the trade calls. Near that of the low, we'll try to take a buy. In the case of Euro, GBP and Australian dollar, near that of the new high, we'll try to keep a sell limit order so that when they fill it, we'll be able to quickly book profit on the downside move of USD-Yen. So these calls, I'll come back by 15:30 GMT, and for about 15 minutes, I'll do the post non-farm payroll data release. The results I will discuss and also review how the players try to trap the traders again and again. We have to be smart enough to understand and should not become victim again and again. So I'll come back by 15:30 GMT and review the calls what I have given it, and try to be very calm. Don't become emotional. Don't become excited with regard to the data. Ultimately, how we are going to handle your trade is vital for you to make money. Just commenting about the non-farm payroll, commenting about the numbers, commenting about the various aspects is of no use, which is of academic interest. But as a trader, we need to earn money from that other market during the spike time. So the spike trade call I have given, and try to make use of it and come back by 15:30 GMT so that we will discuss the results, and then you will understand how we can read the market at ease, and there is no need to complicate our studies. Wish you all the best in your trades.